Markets dropped this month. If you have money invested, your balance is probably down. And that feeling in your stomach is exactly the moment most people make their single worst financial decision. They sell. In the next 6 minutes, I'll show you why doing almost nothing is the smartest move you can make and the 5 steps that protect you when markets fall. In this video, I'll cover what volatility actually is, why the people who stay invested win, and what cash is really costing you, and the one split that stops you panic selling when markets drop. Volatility is just a word for prices moving up and down. Markets do this constantly for 100 reasons. Interest rates, news, fear, headlines. It is not a glitch, it's the normal heartbeat of investing. And it cuts both ways. It's just as much about big jumps up as big drops down. We only really notice it when it hurts. Here is the part nobody internalizes. The up and down is the price you pay for long-term growth. There is no version of investing where the value only ever rises in a straight line. If someone offers you that, walk away. The swings are not the danger, they are the entry fee. Now, let's look at global shares over the last 25 years. Almost every year is different. Some years up, nearly a third, and the worst year down, more than 40%. If you only looked at one single bad year, you would never invest at all. And you can see every major shock right there on the chart. The dot-com crash in the early 2000s, the financial crisis in 2008, the worst single year here, record inflation in 2022, and COVID in 2020, when markets fell about a third in a matter of weeks. But step back. Across the whole period, the average year is firmly positive. And every major crash, 2008, 2020, was followed by a recovery. The market does not promise you a smooth ride. History suggests that it rewards the people who stay in their seat. And the longer you hold, the calmer it gets. Over any single year, the outcome is unpredictable. Over any 10-year stretch, the range narrows dramatically. Notice the green keeps climbing. This is your gains compounding and stacking up over time. But the red, the worst case, keeps shrinking toward zero. Time grows your upside and shrinks your downside at the same time. And time is not just patience, it's your actual risk control. So when markets fall, here is exactly what to do. 5 things. 1. Stay invested. This is the big one. The market's best days tend to come right after the scariest ones. So the people who panic and sell almost always miss that bounce. And staying in matters more than most people realize. Look at this, £10,000, 20 years invested versus sitting in cash. Even at a modest assumed return, the gap is enormous because money left in cash barely grows once inflation has its say. And that gap is the real cost of staying on the sidelines. 2. Stop checking your account every day. We feel a loss far more sharply than a gain of the same size. Watching a falling number hourly is how calm people turn into panic sellers. Check it once a quarter, not every hour. 3. Keep your emergency cash separate. This is the link back to the last week. Short-term money, anything you need in the next 2 or 3 years, belongs in cash. Long-term money belongs invested. If you have that split right, a market drop simply cannot force you to sell at the bottom. 4. Let one fund do your diversification. A single global index fund spreads your money across thousands of companies in dozens of countries automatically. No single company and no single country can sink you. You don't have to be clever, you need to be spread. 5. Invest the same amount every month. When you buy on a fixed schedule, falling prices become a future, not a fear. The same payment automatically picks up more shares whenever the price has dropped. It quietly removes the impossible job of timing the market. Here is the whole video in one idea. Volatility is not the risk. Reacting to it is. A drop on the screen is not a loss. It only becomes a real permanent loss the moment you sell. And turn a paper dip into cash you will never get back. If your money is in the right place for the right time frame, a 20% fall is not an emergency, it's just weather. You wait for it to pass, and historically, it always has. Here is what professionals actually do. They decide their plan once when they are calm, and then they stop reacting to the noise. Set your monthly amount, check it quarterly, not daily, and let the time do the work it is designed to do. That's not a trick. It is just how long-term investing actually works. So here is my question for you. The last time markets dropped, did you hold, buy, or sell? Let me know in the comments. I'll see you in the next one.